Yeah, rules of accounting. You've seen the types of accounting, and now we will look at the rules of accounting. There are two prominent approaches for uh, deciding whether an account is to be debited or account is to be credited. Okay, the American approach and the British approach, and most of us follow the British approach. Okay, let us look at the American approach, then we will come to British approach. Okay, so according to this approach, the transactions relating to transactions are divided just as below: 1, 2, 3, 4. Look at this. Number one, transactions relating to the owner. Okay, what are the transactions relating to the owner? Owner supplies capital. Okay, and he may withdraw the goods. Okay, next, number two, transactions relating to other liabilities, means other than the capital. Who are the liabilities? There may be suppliers of goods, what we call creditors. Okay, next. Number three, transactions related to assets. What are they? Land, building, cash, banks, stock in trade, and receivables, and so forth. Number four, transactions related to expenses. Expenses. Rent, salary, commission, wages, cartage, and so forth. Okay, they're all nominal accounts. Transactions relating to revenues is the fifth one. What are the revenues? You may receive dividend, you may receive, sale proceeds, you may receive interest. They're all nominal accounts. So 4 and 5 are nominal accounts. Okay, and 3 is real accounts. Okay, 1 and 2 are personal accounts. Look at this one: 1, 2 personal, 3 real, 4, 5 nominal account. Okay, 4, 5 nominal account, right? Look at this. If you want to sum up, for assets, increase in assets debit, decrease in assets credit. For liabilities, decrease in liabilities debit, increase in liabilities credit. For capital, decrease in capital debit, increase in capital credit. For the income, decrease in income debit, increase in income credit. For the expenses, increase in expenses debit, decrease in expenses credit. For the stock, increase in stock debit, decrease in stock credit. Okay, this is the British approach. I'm sorry, American approach. Now let us look at the British approach. Okay, now when you look at the transaction, okay, and we will examine how it gets affected. Okay, how a particular account is affected with this transaction. Now, the British approach provides us 3 golden rules. Okay, 3 golden rules. There are 3 types of accounts. That is the categorization of British accounting system. There are 3 types of accounts, and we generally follow this British format. Number one, personal account. Number two, real account. And 3, nominal account. Nominal account. Okay. Now, rule for personal account. Read, some of you. I want Mahesh to read. Mahesh, are you there? Please remember, if you are not responding, I had to mark absent. Okay? That means you're simply logging in and leaving the phone or laptop and going somewhere.
Who's Mahesh, sir?
Mahesh? Who is Mahesh?
Sir.
Bompala Maheshwar.
Sir.
Where are you, boy? Go ahead.
Good morning, sir.
Good morning. Go ahead.
Personal account. Debit the receiver or who owners to be business the credit that given or to whom the business owners.
Okay.
Next is real account. Debit with a come what into business, credit what goes out to the business, out of the business.
Okay.
Normal account.
Lalita, read the third one.
Yes, sir. Nominal account, debit all expenses or losses, credit all incomes or gains.
Okay, okay. So debit or personal account, once again we'll run through. Personal account, debit the receiver, okay, and credit the giver. Let's say Lalita is giving money to Maheshwar Bompala. Okay. So Maheshwar is receiving, his account is debited. Maheshwar account debit. Who is giving? Lalita is giving to Lalita account. Okay, Lalita account. But in the books of Lalita she need not write her own name because it's all her books. So she will write cash because she's giving cash. Maheshwar account debit to cash account because cash goes out. Okay. Now real account, debit what comes in, credit what goes out. Cash is an asset for Lalita. So therefore she credits cash when it is going out. When it is paid, she credits it. Okay. Debit what comes in, right? So Maheshwar debits that cash account debit. Okay, cash account debit to Lalita, he writes that way. Okay, let's come to nominal account, debit all expenses and credit all incomes. Debit all expenses and credit all incomes, right? Okay, now look at this. Please stop me, ma. Okay, at 9:39. Okay, so that I had to log out and log in again.
Okay, sir.
Yeah. Ascertain the debit and credit from the following particulars. Yeah. Started business with capital. Come on. Which account is affecting? Okay. When you start the business, how do you start the business? With capital. What is capital? Capital comes in the form of cash, or sometimes it may come in the form of asset also. You may give your building for business. That's an asset. That is capital, your capital. In the form of building, you're providing. So therefore, instead of cash, you will write here building, right? Now you're providing capital. Increase in cash when your capital is introduced into the business, cash is increasing. So therefore, cash account debit, okay, cash account debit to capital account. Okay, cash account debit to capital account.
Capital account.
Next, bought goods for cash. Bought goods for cash. Cash is going out. Okay, what are you buying? You're buying goods, purchases. Okay, actually it is purchase of goods account. Listen, man. It is purchase of goods account. But what we are writing, some people have practice of simply writing purchases account. Okay, purchases account. Some people have a practice of writing goods account. Some people have a practice of writing purchase of goods account full. So whatever you write, it is correct. It is the same. It is depending on the convention. Purchases account debit to cash. Purchase account is debited. All expenses are debited because purchase is an expense. All expenses are debited. Okay. Look at this. Debit all expenses. Debit all expense. Purchase is expense. Can you see my cursor?
Yes,
When
sir.
I'm moving the cursor, you're able to see, right?
Yes, sir.
Debit all expenses. Look at this. Purchase is an expense, therefore it is debited. Okay. Then cash is going out. Okay. Real account. Cash is an asset, right? Okay. It's a real account. Credit what goes out. Credit what goes out. Cash account is credited. The first line is debit. The second line is credit. This is called journal entry. Okay. Journal entry. First line is debit line, second line is credit line. Okay, purchase account debited, cash account is credited. Let's look at this. Sold goods for cash. This is sales. Okay, when you sell goods, you get cash. Cash is increasing cash. Okay, what's the rule for real account? Okay, debit what comes in. Debit what comes in. Debit what comes in. Cash is coming in, therefore debited. Okay. Now, nominal account. What's the rule for nominal account? Credit all incomes and gains. Credit all incomes and gains. Okay. Nominal account, credit all incomes and gains. Okay. So, what is income? Sales is an income. Credit all incomes. Sales is income, credited. Second line. First line, cash is coming in, debited. Cash is a real account, sales is a nominal account. Okay, next, paid salary. Paid salary. Okay, salary is a nominal account. Okay, and how are you paying the salary? In the form of cash. Cash is a real account. Cash is going out. Cash is going out. Credit what goes out. Okay, debit all expenses. Therefore, salary account debit to cash account. Cash is going out, therefore credited. Salary is an expense, therefore debited.
So
Okay,
it's 9:39.
right, ma. We will close here. Okay. Received interest on investment. Received interest on interest is income, therefore credited. Cash is an asset. It is debit what comes in. Cash is an asset. It is increasing, debited. Next, bought goods on credit from Y. So instead of writing cash, you're writing Y because you did not pay cash. You're writing his name. Paid rent to rent out of personal cash. So personal cash is a capital, right? So rent account debit, which is an expense, to capital account because you're not paying cash out of business but out of your pocket. Therefore, it is capital account. We will close it here. Okay, we will close it here. And please go through this document once again when you're coming to the next class, right? And this is an important document for your entire financial accounting 1. Not only financial accounting 1, for all the other
Accounting and commerce, sir.
semesters, all other accounting papers. Okay, this is an important document. This is a rule. This is the basis for all your accounting. And make it, 6th session document. You have to know every line. Okay, right, ma. So see you in the next class.